Hello everyone, welcome to our BDO financial reporting update for September. The webinar today is expected to take probably about 45 minutes. If you do have any questions, use the Q&A to host function please, and we'll be collating those questions and hopefully either answering them at the end of the webinar or getting back to you subsequently. Presenting today are myself, Elisa Noble, and my colleague Grant Hasty. We are both from the technical financial reporting team here at BDO. So, on the agenda today, our main topic will be narrative reporting changes, in particular on directors' remuneration reports and corporate governance. In respect of corporate governance, this will be looking at both the large private company requirements coming in for the first time this year and also changes to the main UK corporate governance code. All of those requirements effective now in 2019, so very topical. Towards the end of the webinar, we'll also be looking at some IFRS updates relating to implementation challenges on IFRS 16 and also a few other IFRS amendments coming up in the pipeline. And we'll be finishing off with just a couple of UK GAAP updates. So, starting with the narrative reporting changes then. This slide might look hopefully a little bit familiar to some of you who've joined us previously. So, to remind you, back in 2018, something called the Companies Miscellaneous Reporting Regulations 2018 were issued. And these regulations introduced a number of quite significant changes for large company narrative reporting requirements. Basically, there are 6 new disclosure requirements, all with a slightly different scoping, but all of these apply to large companies. In our last webinar in June, we looked at the first 3 items on the list on the screen, in particular the Section 172 statement. So now this time we'll be looking at the last 3 items highlighted in blue there, which introduce some changes to directors' remuneration reports and also bring in the statement of corporate governance arrangements for some very large private companies in the UK. We then also have now in 2019 some further changes to directors' remuneration reports, so we'll tell you about those and also update you on a few other corporate governance related matters. So all of this is going to take a little bit of time, just to warn you. So, directors' remuneration reports. At the moment, it's quoted companies as defined by the Companies Act who are required to prepare a statutory directors' remuneration report in the UK. I'll come back to what that definition means in just a moment, but at the moment it's in the 2018 regulations, 2 new disclosure requirements were introduced relating to CEO pay ratios and the effect of future share price changes on executive pay for quoted companies preparing directors' remuneration reports. These changes are now effective for periods beginning on or after 1st of January 2019. So what do you need to disclose? The first requirement is that those quoted companies who have more than 250 UK-based employees, and that is calculated on a consolidated group basis if you are a parent company, so they'll need to disclose the ratio of the CEO's pay to the 25th, 50th and 75th percentile pay levels for their UK employees. This will build up to a 10-year record over the years in the annual report, and you also do have to provide some additional supporting and explanatory information. in order to, if this affects you, for more information on how you might actually calculate this pay ratio, this is explained in detail in an FAQ document published by BASE, the Department of Business, Energy and Industrial Strategy. Okay, so the second requirement then is applicable to all quoted companies, and this is about explaining the effect of share price changes on executive remuneration. So what you need to do here is in the policy section of the Director's Remuneration Report, include an illustration of the possible impact that share price growth may have on remuneration that is based on performance targets or measures relating to more than 1 year. And so that is in the policy section of the report, and that actually is applicable for any policies for shareholder approval from 1st of January 2019 onwards. So that is already applicable for year ends earlier than December 2019. In addition to that, two other disclosure requirements for the report section of the Director's Remuneration Report, explaining, firstly, in the single figure remuneration table, an estimate of the amount of that remuneration attributable to share price appreciation, and an explanation of whether and how discretion has been used by the Remuneration Committee, as well as a summary of how discretion has been exercised in the actual chair's statement, typically included right at the beginning of the remuneration report. Okay, so those are the 2018 new disclosure requirements now effective in 2019. Now, as it happened, we already have another set of regulations issued in June 2019. And these regulations now slightly extend the requirements and the scope for companies who have to present a statutory director's remuneration report. So far, that has been for quoted companies as defined in the Companies Act, which is UK-registered companies listed on the London Stock Exchange, New York Stock Exchange, NASDAQ, or any other EU-regulated markets. This excludes companies listed on AIM in the UK. So what has changed is now directors' remuneration reports are also required for UK-registered traded companies. So that means unquoted traded companies, so any company traded on a regulated market in the UK or an EEA state. This still excludes AIM-listed companies and will primarily apply or extend the requirements to those listed on the London Specialist Fund segment. Such companies may need to produce and present for shareholder approval for the first time a director's remuneration policy. If you are in that situation, then 10th of June is an important date, and for any quoted or traded companies, any policies for shareholder approval from 10th of June 2019 onwards must comply with the changes, which I'm about to tell you about. And then we also have some actual disclosure changes which will be effective for financial years beginning on or after 10th of June 2019. So for a December year-end company, those will come in next year, December 2020. So not going to go into the complete detail, but the key changes that are required in the remuneration policy are to provide some additional detail on basically vesting and holding periods for shares. So that's when shares indicatively awarded can actually be granted or exercised. Information on directors' service contracts and an explanation of the decision-making process to arrive at the remuneration policy and any changes in that policy from the previous one. For example, premium listed companies may in fact be already complying with these requirements due to the Corporate Governance Code or the listing rules, but you probably need to just check that you've got those disclosures in the right part of your remuneration report. Okay. Then the changes coming in for periods from 10th of June 2019 onwards in the remuneration report is some additional information about annual changes in directors' pay compared to employee pay over a 5-year period. And for the single figure table, some additional columns to show a subtotal of the split of fixed and variable pay for each director, as well as changes made to share options. All right, so those are all the changes to directors' remuneration reports. If you might be affected by those changes, then take a look at these guidance documents, 2 FAQ documents published by BEIS on the regulations issued in 2018 and 2019, and additionally, the GC 100 and the investor group publish a very comprehensive guide on directors' remuneration, which is now fully up to date with the latest changes. Okay, with that, we'll move on to corporate governance. Grant.
Okay, thank you, Elisa. So as moving on to corporate governance, the past few years have seen a lot of focus and debate on UK corporate governance. A decline in public trust in business has been caused in part by high-profile business failures such as BHS and Carillion, and accusations of excessive executive pay, unethical tax avoidance by multinational businesses, and deteriorating relationships with employees, overpay, and contractual terms. These facts have led to prime ministerial statements, select committee inquiries, public consultations, a government green paper, changes in stock exchange rules, and the updating of corporate governance codes. Some 2 major changes have been applicable for periods beginning on or after 1st of January 2019. And so the first major year end for which annual reports will be affected is fast approaching, so it is a good time for a reminder of what those changes are. Okay, but before we go into the detail of those changes, it is worth putting them into the context of the pre-existing corporate governance requirements. So up until 1st of January 2019, the main driver of corporate governance requirements were stock exchange rules and laws that apply only to companies listed on EU-regulated markets. Okay, so for example, we've got on the screen, companies that are listed on the main market of the London Stock Exchange will be subject to the Disclosure Guidance and Transparency Rules, or the DTR, which imposes certain basic standards of corporate governance arrangements, such as the establishment of, for instance, an audit committee. A company that was subject to only these rules had a choice over whether it adopted a formal code of corporate governance, and if it did, which code it might adopt. It also had a choice about whether the corporate governance disclosures specified in the DTR were included in its annual report or on its website. In addition, companies with, say, a premium listing on the main market of the London Stock Exchange were also subject to the more stringent requirements of the listing rules, which require the adoption of the UK Corporate Governance Code and specify specific governance disclosures that need to be presented in the company's annual report. And finally, quite recently, so from 28th of September 2018, companies on the London Stock Exchange's AIM market have been required to adopt a recognised code of corporate governance and to disclose information about its compliance with its chosen code on its website. So in terms of which codes of corporate governance are being used by these companies, so as I indicated just now, premium list companies must adopt the FRC's UK Corporate Governance Code. Whilst the AIM rules do not specify which recognised code of corporate governance an AIM company must adopt, the companies listed on this market have almost exclusively opted to adopt the quoted Companies Alliance's Corporate Governance Code. Adoption of a formal code is not required under the basic rules of the DTR, but those companies that do choose to formally adopt a code will generally make a choice between the FRC's code and the QCA code. So the changes effective from 1st January 2019 have not affected these basic factors. However, there have been some major changes to the UK Corporate Governance Code itself, and Elise is going to go through that in a moment. But before we do, conspicuous in their absence from formal corporate governance arrangements are private companies, which is what I'm going to be going through with you now. Okay, so this is where the second kind of major change has occurred. And these have resulted from changes to the Companies Act. Regulations have introduced a new corporate governance requirement that applies to the UK's larger unquoted companies. So associated with these new requirements, a new set of corporate governance principles, so they refer to them as the WAIT principles, that are aimed at large private companies, which are the class of company most affected by this new requirement. We will take a look at the exact scope of these requirements, or these new rules, now before Elisa will take you through the new UK Corporate Governance Code. Okay, so as an overview, these new requirements are effective for periods beginning on or after 1st of January 2019, and they apply to UK incorporated companies. They do not yet apply to LLPs. Companies within scope must prepare a statement of corporate governance arrangements, which is both included in the Director's report of the company's annual report and published on its website. Okay, so the scoping requirements are a little counterintuitive, so we've got them on the screen there, and it's firstly very important to note that they apply at an individual company level rather than at a consolidated or group headed by level. The requirements, or the qualifying conditions for these requirements is that companies with more than 2,000 employees and or a turnover of more than £200 million and a balance sheet total of more than £2 billion will fall into scope. So that companies basically that meet either or both the employee threshold or the financial thresholds, which obviously on, as you can see, reference turnover and total assets, will fall into this scope. There are some reliefs for companies that occasionally dip above and below the thresholds, and some specific exemptions for certain types of companies, which will come through, which we'll talk about in a little while. Okay, so to illustrate the application of the qualifying conditions, we're going to look at two very similar groups which are on your slides. So we've got Group A and Group B. Assuming the financial thresholds are not met by any of the companies on a standalone basis, only one of these companies will fall within the qualifying conditions of this new requirement based on employee numbers, and that is Subsidiary 2. Okay, so none of the other companies individually qualify. Only Subsidiary 2 would need to prepare a statement of corporate governance arrangements and present it in its annual report and on a website. A statement of corporate governance arrangements is not required in the consolidated accounts of the parent, even though the group as a whole is above the employee threshold, as the consolidated position of the parent company is not relevant. As we've already noted, the strict reading of the scoping requirement does seem a little counterintuitive, as substantively similar groups would be in scope or out of scope of these requirements based solely on their corporate structure. We believe that this is an intentional decision by the government when drafting the legislation, as it did make clear that only a handful of companies would be caught by the new requirements. However, it is possible that market practice and stakeholder expectations will develop such that voluntary governance disclosures become more commonplace in groups that meet the thresholds on a consolidated basis. Okay, so I mentioned earlier some reliefs for companies that occasionally dip above and below the thresholds. These are constructed in a very similar way to those that apply to the size definition in the Companies Act, in that after the first year in which these rules apply, a company must meet or not meet the qualifying conditions for 2 years running for a change in status. So that is either bringing the company into the scope of the requirements or allowing them to drop out. Okay, so moving on to the scope exclusions, the requirements do not apply to companies required to provide a corporate governance statement. They also don't apply to community interest companies or charitable companies. And the term corporate governance statement is defined in the legislation, and it refers to the DTR requirement to prepare a corporate governance statement. So this means that only companies that are required to prepare a corporate governance statement under the DTR are eligible for this exemption, not those that voluntarily prepare one, and not those that prepare one through the action of some other law or regulation. Okay, so to illustrate this, the effect of this point, we've got two more groups, so Group C and Group D. We already know that the subsidiaries, that subsidiaries 6 and 8 meet the qualifying conditions on an individual basis, and so fall in the scope of these new requirements. But for these groups, it also looks like the parents one parent's got a main market listing and the other one has an AIM listing. So they've each got employees of 2,000 people on an individual basis. Okay, so they'll fall in scope. However, both parents would be expected to make some corporate governance disclosure. So parent C under the DTR and possibly the listing rules, depending on which segment of the main market it is listed, and parent D under AIM Rule 26. However, only parent C is exempted from this new requirement because it is the only one subject to the DTR's corporate governance requirements, so they have to prepare a statement. Parent D would fall within the scope of both the AIM Rule 26 requirement and these new requirements, and this has a greater significance than may first appear because AIM Rule 26 is a website-based requirement, whereas these new company law requirements mandate the related disclosures should be included in the annual report, specifically in the director's reports. Okay, so what should the statement of corporate governance arrangements actually say? So the disclosure requirements when the company applies a recognised code of corporate governance is quite clear. The disclosure must identify the code, explain how it has been applied, and highlight where and why there are any departures from the chosen code's requirements. Where a company chooses not to apply a recognised code of corporate governance, it will have to justify that decision in its annual report and explain what governance arrangements are in place. There isn't much guidance on what level of detail that might entail, other than the definition of corporate governance included in the legislation, which we've put on the screen for you to read. Okay, in order to address the different governance needs of private companies, which arise because they generally have a much closer relationship with their shareholders than a listed company, a new set of governance principles were developed to complement the new legal requirements. As we kind of went through on the scoping slides, the weight principles features 6 high-level principles under the headings noted on the slide, with some explanatory guidance which provide a framework with which to both develop appropriate governance structures and to report on them. So like the QCA code, it does not include any explicit detailed provisions about what governance structures and processes should be in place, and therefore, in that respect, it is also very much an apply and explain set of principles rather than a comply or explain code. So the weights principles, of course, are not the only choice available to private companies. They may seek to apply either the FRC's code or the QCA code instead, but their application would need to be adjusted to take account of the differing ownership circumstances. This would potentially lead to the need to explain non-compliance with certain aspects of these primarily listed company codes. This would be particularly the case for the detailed provisions of the UK Corporate Governance Code. So these are the changes applicable to large private entities, which we just cantered through, but sticking with corporate governance, Elisa will now take us through the changes to the UK Corporate Governance Code.
Okay, thank you, Grant. So, we had a revised version of the UK Corporate Governance Code issued back in July 2018, and this is effective for periods beginning on or after 1st of January 2019 again. So we will be seeing companies begin to report under the revised code during the December 2019 reporting season. There have been substantial changes to the structure of the code this time. The new code is now much shorter and sharper. It has fewer provisions, 41 compared to 55 in the 2016 version of the code. And also, all of the 27 supporting principles previously included have now been removed. This means that the new code, the new version of the code, is now a much more concise document. And this has been in part achieved by transferring some of the content to some of the associated guidance published by the FRC on corporate governance matters. So the UK's corporate governance framework is based on a system of shareholder primacy, and there is no change to that fundamental concept. However, one of the key changes of the revisions made in the 2018 code is that the definition of governance is somewhat broadened in order to emphasize more strongly the board's responsibilities towards other stakeholders, including workforce, suppliers, and the broader community. So to this end, the key changes are intended to encourage and facilitate positive relationships between companies, shareholders, and other stakeholders, ensure the company has a clear purpose and strategy aligned to a healthy corporate culture, stress the importance of high-quality board composition with a focus on diversity, and promote remuneration, which is both proportionate and supports the long-term success of the company. So that's 4 areas: stakeholders, corporate culture, board composition, and remuneration, which are the key areas where we've seen changes in the 2018 version of the code. So we'll take a bit of a look at what this actually might mean in terms of specific changes to provisions, which may or may not result in, or in fact are likely to result in some disclosure changes in the corporate governance report. So in terms of workforce, there is now a new provision encouraging greater board engagement with the workforce in order to understand their views. And the corporate governance structure should include, or there is a recommendation to include one or a combination of either a director appointed from the workforce, a formal workforce advisory panel, and or a designated non-executive director with responsibility for workforce engagement. And if you don't comply with that provision, then you would need to include an explanation in the annual report for what alternative arrangements are in place in relation to workforce engagement. Excuse me. Secondly, there is something which basically mirrors the new Companies Act requirement for a Section 172 statement explaining how the board has considered stakeholder interests in their board discussions and decision making. So this requirement in the code is slightly more detailed in specifying the information to be provided, and importantly also extends this type of reporting to overseas companies which may not fall within the scope of the UK Companies Act Section 172 statement, otherwise required in the strategic report. In terms of corporate culture, this has greater emphasis in the new code. It's mentioned several times in principles and provisions, and there's a requirement to assess and monitor culture and basically ensure that there is a culture in place aligning company values with strategy. In terms of board composition, what there is about this is an emphasis on the need to refresh boards and undertake succession planning. So this is being achieved by strengthening the role of the nomination committee in relation to these matters. So there are specific disclosure requirements also in the nomination committee report on matters related to succession planning and establishing diversity at the board level, and also on the topic of external board evaluation. Finally, in relation to remuneration, the 2018 code is much more explicit in that remuneration committees are expected to take into account remuneration, workforce remuneration and related policies when they set directors' remuneration. Any formulaic outcomes from remuneration schemes are highlighted as an area where remuneration committees could and should exercise their discretion when the outcome of performance-related pay arrangements looks like it might not be justified. Okay, so what does this actually mean for annual reports and corporate governance statements in annual reports? Apart from specific new disclosure requirements included in some of the provisions of the code, some companies may need to or may want to revisit how they provide their corporate governance disclosures in their annual reports in order to match the changed structure of the new code and also to ensure that they are addressing how the principles have been applied. So currently, many code-adopting companies structure their governance reporting around the 5 broad sections of the UK Corporate Governance Code. As you can see from the slide, while the 2018 code is still split into 5 sections, those sections are different, and the principles and provisions under them do not exactly map to those that featured in the previous 2016 code. So that means that you may need to make some changes to your structure. And also, there is now basically a greater emphasis coming through from the communications of the FRC, which is consistent with the requirements in the listing rules, to explain at quite a granular level, really, how the company has addressed the individual principles in the context of the circumstances of the company. So there's a bit more focus on this aspect of the reporting. So it's probably a good idea to think about looking at how those would apply to your group at this stage. That's all we have to say on the changes introduced in the code. Just some related guidance. We mentioned that the FRC does publish associated guidance, and one of the things that has been reissued is the guide on board effectiveness. This now includes some of the material previously included in the code and is a very practical reference. Additionally, there are 2 recently published guidance documents for audit committees. The ICAEW and the FRC have published something addressed specifically at smaller listed and AIM-quoted companies' audit committees. And just very recently, the QCA has also issued a revised version of their audit committee guide. Okay, so that was a lot of information on directors' remuneration reports and corporate governance. Next, we will shift our attention back to accounting matters with a few updates on IFRS. So, of course, IFRS 16, the new standard on leases, is probably one of the most significant changes affecting IFRS reporters in 2019. We've been talking to you about that in a number of our webinars, and today we just have a few things to mention in terms of areas where some companies are facing some implementation challenges. In addition to that, we'll touch on some changes coming through to IFRS a bit later on. Okay, so the first point on IFRS 16 is something which the IFRS Interpretations Committee was asked to consider, and in fact they issued a tentative agenda decision in June this year. And this is on the topic of cancelable leases and how you would assess the lease term for those leases. Now, IFRS 16 does include quite a lot of guidance on how the lease term should be determined. And it is, of course, important because that will affect the amounts included in the right of use asset and the lease liability recognized by lessees under IFRS 16. So what do we mean by a cancelable lease? These are actually quite common. Sometimes they're called, some people call them evergreen leases. So these would be leases which might not have a specified term in the contract. They might continue indefinitely or perhaps be automatically renewed after an initial fixed period. And usually both parties to the lease, the lessee and the lessor, can cancel the lease by giving notice. And relevant to the facts, sometimes the lessee may well have made significant leasehold improvements, incurred costs, on that and would incur further costs to remove those leasehold improvements if they were to vacate the property. So the question here is, what is the lease term for this type of lease? Is it simply any initial fixed period and that after that the lease is considered unenforceable because both parties are able to give notice to cancel? Or do you need to think beyond that, and could the lease term actually be longer and extend beyond the non-cancelable period? What this comes down to is looking at whether the lease is enforceable. And what IFRS 16 says on this point is that you do need to look at whether both parties to the contract incur any penalties to terminate. If both parties to the contract do not incur more than an insignificant penalty to terminate, then the contract can be considered unenforceable and you would not have any lease to account for. But for this type of cancelable lease with significant leasehold improvements incurred by the lessee, the Interpretations Committee concluded in their tentative agenda decision that actually it is possible that the lease term will extend beyond the initial period, because in this case it does look like one of the parties is incurring more than an insignificant penalty, and that is because you need to consider the broader economics and consider things like leasehold improvements. So that would mean that the IFRS 16 accounting would potentially result in much bigger numbers for such lessees. So that's something to look out for if you have cancelable leases. Three other areas where companies are finding possible issues in practice. So intra-group leases. Many groups have a lot of leases between group entities. Under IFRS 16, lease accounting is no longer necessarily symmetrical between the lessees and the lessors' books. Lessors may still record some leases as operating leases, while the lessee may record a right-of-use asset and a lease liability for that very same lease. Also, incremental borrowing rates may well be different between different entities in a group. So all of this means that the consolidation process may be quite complex when all these group lease accounting effects need to be unwound and eliminated. Sometimes in group situations, lease arrangements might also be undocumented or the documentation may be incomplete. That rarely means that you are able to avoid IFRS 16 accounting. Instead, it's likely to make it a bit more complicated and potentially judgmental. Now, variable lease payments which depend on an index or rate are quite common, and these types of lease payments under IFRS 16 do need to be included in the amounts to calculate the lease liability and the right of use asset recognized. So then the lessee is required to remeasure the right of use asset and the liability if there is a change in the lease payments under the lease contract as a result of a change in the index or rate. So this, in practice, is causing a lot of questions for exactly when do you need to reflect the debits and credits to change your lease accounting for changes in these indexes or rates, which typically do change frequently. So the point here is that you need to focus on what it says in the contract on when the lease payments will change, and there is no requirement for lessees to be forecasting changes in indexes or rates. Okay. Finally, on impairment models, and this has been overlooked by some companies, so various impairment testing approaches and models may need to be revisited as a result of IFRS 16. So this is because right-of-use assets now need to be tested for impairment under IAS 36. Also, discounted cash flow calculations performed in order to measure recoverable amounts, value and use may need to be revised. They would typically have included previously operating lease rentals under IAS 17, but under IFRS 16, as lease payments would typically be considered finance related costs, any such lease payments included in the lease liability would normally need to be excluded from your discounted cash flow from the cash outflows. Only short-term, low-value or some types of variable lease payments would expect to be normally included. So that means that you might need to make changes to the various spreadsheets you might have for impairment testing. There are also considerations on exactly how you test right-of-use assets for impairment, including which CGU you might allocate your assets to, and in some situations, what the actual assets and liabilities to be included in the CGU are to assess its recoverable amount, in particular whether lease liabilities occasionally should be included. So that's a few reminders on IFRS 16, and Grant will now explain what's coming up in the world of IFRS amendments.
Okay, thanks, Elisa. So the ISB has issued a number of exposure drafts. We've got them listed on your screen at the moment, which propose mostly narrow kind of scope amendments to IFRS. While these exposure drafts are still at the proposal stage and have not yet been finalised, we'll take a brief look at just a few of the ones listed on the slide over the next few slides, that you have an idea of what is coming up. In particular, I will be going through the first two that are highlighted in blue, and Elisa will be going through the last one, well, the other one highlighted in blue on IAS 12. Okay, so the proposed amendments to IAS 37 for onerous contracts. So in December 2018, the ISB published for public comment proposed amendments to IAS 37 to specify which costs a company should include when assessing whether a contract will be loss-making. A company determines that a contract will be loss-making and describes it as onerous if the costs of the company or the costs that the company expects to incur to fulfill the contract are higher than the economic benefits it expects to receive from it. Currently, there are different views around which costs should be included in a company's assessment of the costs of meeting the obligations under this contract. So some companies include only incremental costs, whereas others include all directly related costs, which is obviously a broader definition. The issue has been brought to light as following the adoption of IFRS 15, the guidance previously included in IAS 11 for loss-making contracts has been removed. IFRS 15 does not include such guidance, and entities must turn to IAS 37 to assess whether a provision is required. The board has proposed to amend IAS 37 to specify that the costs of fulfilling a contract include both incremental costs, such as the cost of materials, and an allocation of other costs directly related to the contract, such as the depreciation charge for equipment the company uses to fulfill contracts. The inclusion of an allocation of indirect costs in a company's assessment of whether a contract is onerous would be a change in approach for some companies and may lead to earlier recognition of a provision and potentially a larger provision. The proposals apply to all contracts, not just contracts with customers. So the ISB has not yet proposed an effective date. Application is expected to be prospective from the date of initial application of the amended standard. Okay, so next up are proposed changes that aim to provide a relief on specific aspects of hedge accounting in order to prevent certain hedge relationships being discontinued as a result of the uncertainties arising from IBOR reform. So this was the proposed amendment, and we've just got news as of last night that the amendments should be coming through tomorrow. That's Thursday the 26th of September, so this is quite hot off the press. But before we go any further, if you've never heard of this, what are IBORs and what is IBOR reform? IBORs are interest reference rates, such as LIBOR and Euribor. They represent the cost of obtaining unsecured funding in a particular combination of currency and maturity, and in a particular interbank term lending market. Since the financial crisis, however, the long-term viability of IBORs has been called into question, and following a fundamental review by the Financial Stability Board, numerous jurisdictions have developed plans to replace IBOR rates with alternative interest rates, which are risk-free interest rates that are based to a great extent on transaction data. Okay, so what does this actually mean? So in terms of accounting, IBOR-based products are everywhere, and the changes to this reference rate can have a significant effect on the accounting for these financial instruments under both IFRS and UK GAAP, both in the period leading up to and at the time these IBOR kind of rates are discontinued. The issues can therefore be categorized into pre-replacement issues and replacement issues, which we're going to cover now. So pre-replacement issues are issues arising in the period leading up to the date IBORs are discontinued. We could call this the period of uncertainty, which is what we're in now, and primarily affects interest rate hedge accounting, where potential changes in interest rates could cause hedge relationships to be discontinued under current accounting standard requirements. Replacement issues include those issues arising at the time IBOR is replaced. For example, whether a modification of the contractual terms of a financial instrument to reflect this new rate should result in that financial instrument being derecognized, and the implications of this on any hedge relationships. So coming back to the proposed changes, and we've got some good news. Both the ISB and the FRC respectively have issued exposure drafts that propose amendments to IFRS 9, IAS 39 and IFRS 102, which will effectively allow preparers to disregard IBOR reform in this current period of uncertainty when evaluating whether hedging relationships should be discontinued. The second phase will address the replacement issues which arise on the date IBOR is discontinued, and it is expected that further amendments to IFRS 102, IAS 39 and IFRS 9 will be proposed in due course to deal with the implications that could arise as a result. So we will keep you up to, kind of updated as these things progress, but I'm going to hand over to Elisa to go through the final change. Here we go.
Okay, so this exposure draft in turn is proposing changes to IAS 12 income taxes, and in particular the deferred tax accounting in situations where you recognize an asset and a liability from a single transaction at the same time. So this could happen, for example, with lease accounting under old finance lease accounting, or very topical at the moment, IFRS 16 lease accounting for right-of-use assets and lease liabilities. It is also relevant to situations like decommissioning obligations where you recognize an asset and a provision. So what's unclear, what the question is does the IAS 12 initial recognition exemption apply and mean that you don't need to recognize any deferred tax? That's been a little bit unclear, and this amendment proposes to clarify that the initial recognition exemption in fact does not apply, and that does mean that there would be some deferred tax accounting required for situations like this, where equal amounts of temporary differences might arise. Okay. Final point on IFRS is also tax-related, and it's just to bring to your attention that ESMA, the European Securities and Markets Authority, issued quite a useful statement relating to the accounting for deferred tax assets on unused tax losses. So the basic principle, of course, is that those deferred tax assets should only be recognized to the extent it is probable that future taxable profits will be available against which unused tax losses can be utilized. And in practice, of course, that is a bit challenging often for entities and very judgmental to assess. And basically, in their statement, ESMA focused on two particular challenges. How a company should assess probability of future taxable profits being available, and in particular situations where an entity has a recent history of making losses, that in those cases convincing other evidence needs to be in place in order to recognize deferred tax assets. What's useful about this statement is that they set out lists of what they call negative evidence and positive evidence for companies to consider in that applying into their situation to see whether or not it will be appropriate to recognize deferred tax assets. Okay. Finally, very briefly, two UK GAAP updates. So Fred 70 is now no longer FRED, is amended. So FRS 101 cannot be used by insurance companies when IFRS 17 becomes effective. Unlisted insurance companies will have to apply either full IFRS or FRS 102. This is effective from 2021. And finally, FRED 72 is the FRC proposal to amend FRS 102 to address the hedge accounting related issues arising from IBOR reform, which we've just explained to you under IFRS. That brings us to the end of our financial reporting webinar today, and we hope that you have found it interesting and informative, and do join us for our next webinar. It looks like we're a little bit over time, so we'll be looking at any questions that have been sent in and get back to you separately on those. Thanks.